In this video, we'll talk about Section 1245 Depreciation Recapture, Section 1250 Depreciation Recapture, and under Capture Section 1250. Let's first start by talking about Section 1245 Depreciation Recapture. The general idea is, let's say you sell property. Let's say you sell some business equipment that you've held for many years. Well, under the tax law, Section 1231, when you sell that property, that business property is going to apply. And let's assume it's the only transaction, the only 1231 transaction you have. Well, going back to the 1231 topic, and if you don't know that, you can look at my 1231 video. That 1231 gain, net 1231 gain, will result in a long-term capital gain. Well, long-term capital gains to individuals and taxpayers other than corporations result in a preferential tax treatment rather than ordinary gain. So the idea there is that you're getting potentially, you're saving 17% at the current time of this video, because at the current time of this video, the highest or long-term capital gains rate, normal long-term capital gains rate is 20%. The highest ordinary rate is 37%. Now those rates can change in the future, but the idea still stays the same. So that's a 17% tax savings. All right, well, during the life of that equipment, you took depreciation. Well, that depreciation resulted in ordinary deductions that reduced ordinary income from your business activity. Well, let's say you're in the highest bracket. So here's the idea. It's a matching issue, right? The equipment, over the life of the asset, it creates depreciation deductions. Those depreciation deductions, again, have a tax benefit of 37%. So 37% tax benefit. And when that equipment is later sold, when we later sell it, again, assuming it will be a Section 1231, because let's assume we held it for more than a year. We sell that business equipment. Well, now, assuming it's the only 1231 transaction, when we net those gains and losses, because it's the only one, we have a net Section 1231 gain, is long-term capital gain. And again, time of the video, highest normal long-term capital gain rate is 20%. So right there, we got, boom, we got 37% tax benefit. We have a 20% tax on it. That is a 17% tax savings or tax arbitrage, because the idea is you were able to get tax benefit from that by deducting from ordinary income that will be subject to 37%, and then when you sell it, it's subject to 20%. So that issue, Congress enacted Section 1245, and actually that issue is more broad, in a broad sense, is actually the Supreme Court in the Aerosmith decision. But Section 1245 is an example of the Aerosmith decision, and what the Aerosmith decision deals with is basically tax matching. So let's just stick with Section 1245 because it's the easiest way to understand it. The idea is if you sell it for a gain later, right, you have this 20% tax gain. However, you got 37% tax benefits. What Section 1245 is going to do or try to do, again, it's not perfect, okay? It's hard to make a perfect way to fix this. It's going to try to recapture the amount that would be taxed at 20%. It's going to make that 37%, making it ordinary income. So Section 1245, it only applies to personal property, not real property, okay? Both intangible and tangible. So it's not only depreciation, it's depreciation. So it's depreciable and amortizable property. It applies to both. Personal property, that's depreciable or amortizable. It also only applies to gains. Now, if you remember, depreciation and amortization can be taken on either business property or investment. Can't be taken on personal use. So that right there means this could be a business or investment topic. It has to be a gain, cannot be a loss when it's later sold, right? If we sold the equipment for a loss, guess what? Section 1245 depreciation recapture does not apply. It would be only on gains because of this issue. So we have a gain on the sale or exchange or involuntary conversion, whatever it is. The next step is we're going to take the lesser of the realized gain, I should say realized recognized. And the reason I'm saying that is because there's some rules that basically, when we have non-recognition, that you don't have to worry about Section 1245. But there's others that you do. For example, if you have non-recognition due to a corporate formation, a like-kind exchange, involuntary conversion, those events, well, Section 1245 does not trump those provisions, so still no gain or loss recognized. However, if it's an installment sale, which is also a non-recognition rule, well, guess what? The Section 1245 rules would trump and make the portion of the gain that's subject to Section 1245 immediately, you have to record that. You have to recognize that. Okay. Now with that, with non-recognition rules, you still have to keep into the future any Section 1245 recapture that's potential. That is potential. Okay. So it's the realized recognized gain. That's all I'm going to say with respect to that. Let's assume in our transactions that we're selling, right? We're selling. We have a sale. Well, there's no non-recognition rules that apply to sales because you're selling for cash. Okay. So it's the lesser of the realized recognized gain or the amount of depreciation. So total depreciation amortization taken. Okay? The depreciation amortization taken. So you take the lesser of those two numbers. Well, that means that it's possible. Let's say we sell this for, we sell this equipment for $15,000. $15,000 sale. We took $9,000 of, I'm sorry, we sell it. We have a $15,000 realized and recognized gain, I should say. We took $9,000 of depreciation. Well, the lesser of the $15,000 realized and recognized gain and the $9,000 depreciation, we're going to have $9,000 of Section 1245 ordinary income. It's the ordinary income recapture. That's what's known as. And then the remaining portion, the remaining $6,000, will continue to be Section 1231. So whatever it was. Okay. Now another thing is that Section 1245, because of the way this what happens, Section 1245, it recaptures certain characterization, certain character as ordinary. Okay? And that character that it recharacterizes, it has to be capital gain, either long-term or short-term, or Section 1231 gain, either one of those. That's really what we focus on. Capital gain, short-term or long-term, or Section 1231 gain. So that's really all Section 1245 does. Okay, it just, again, we look at personal property. So it can be tangible or intangible personal property, not personal use, personal like personal versus real. You have to have a gain on the transaction, and the gain must be capital gain or Section 1231. If it's ordinary, well then you're recapturing ordinary as ordinary. It makes no difference, okay, because all this does is just make ordinary, okay, it just makes it ordinary. And then we apply the lesser of rule, the lesser of the realized recognized gain or the total depreciation amortization taken over the life of the asset. And again, it's kind of like a matching. Again, it's not a perfect system because we could have a gain of, let's say, $5,000 gain. We take $9,000 of depreciation. Well, the lesser then is $5,000 of the whole realized gain and recognized gain is going to be considered ordinary, but we still got tax benefit. Okay, so that's the idea. It's not a perfect system, but at least it helps us get there. Okay, let's move on to Section 1250 depreciation recapture, next topic. So Section 1250 depreciation recapture, this applies to real property. Real property is subject to depreciation. And even further, again, it applies to gain on these transactions. And then here's the kicker. And this is why Section 1250, the way it stands in the code, is pretty much irrelevant, the way it stands right now. It only applies to real property that's depreciable. So we're talking about buildings and similar items. Again, real property subject to depreciation. Acquired before 1987. And here's what happened. Before 1987, so 1986, we have the Tax Reform Act of 1986. A lot of changes in tax law. One of those changes, okay, so the 86 Tax Act, one of those changes, what it did was it changed the depreciation for real property subject to depreciation from accelerated depreciation, okay, accelerated depreciation, like we have of makers, more than 100%. So real property was subject to accelerated depreciation. And then in 1986, starting in 87, so 1987 on, we have straight line depreciation on real property subject to depreciation over 27.5 or 39 years. So that's the rule that you know from tax in terms of how we depreciate. So with this, the Section 1250, the way it stands in the code, what it did was it said, okay, well, any property acquired before 1987, going forward, we're going to take the accelerated depreciation that's been taken minus the straight line depreciation, and the difference, that portion, is going to be recaptured as ordinary income. Because generally, if you have business real property or even investment real property that's been depreciated, it's going to be long-term capital, so capital gain, long-term or short-term, right, or Section 1231. So it's a similar idea to Section 1245, but what's different is that it's not, okay, we just look at the amount of depreciation, the lesser of. No. What we do is we take the accelerated depreciation, which again came before 1987, we subtract away what would be the straight line if we were calculating it using straight line, and we recapture that as ordinary income, that amount. The remaining portion would be whatever's left. Now, this is virtually pretty much wiped out, and the reason why, if you think about it, is most property acquired before 1987 has been either it's gone, or if you think about it, right, let's say property was acquired at the end of 1986. All right. Well, even if it's 39-year property, think about how long into the future that would go, right? 40 years would be 2026. Okay. And depending on when you're watching this video, as you can see, it's pretty much becoming irrelevant, right? It might be 27 and a half year. If it's 27 and a half year, then it's definitely irrelevant by the time you're watching this video. 39 year, we're getting to that point where it still could be relevant, but less and less relevant. Okay. All right. So that's Section 1250 as it stands. Really, Section 1250 depreciation, it really affects three different things. Well, not as the way it stands in Section 1250, but elsewhere in the tax law. So the one we just talked about, that's the main Section 1250 rule. And again, it's virtually pretty much wiped out. Now, you still need to know conceptually what it did. And again, the focus is that accelerated depreciation minus straight line depreciation. Because again, before 1987, you were allowed to do accelerated depreciation more than 100% straight line, so 150% decline balance or 200% decline balance on real property subject to depreciation before 1986. Minus a straight line, what it would be under straight line. That's what you need to know. That's what the CPA exam focuses. That's what I focus on. That's what other professors like to focus on. Just generally what the idea is. And also how it fits in with the other Section 1250 items. So that's the first item in Section 1250. That's on its face. The second item in Section 1250 is what's called Section 291. Section 291 is actually a corporate tax rule. So this applies to corporations. And what it does is there's certain amount of depreciation recapture that has to be taxed again as 20% as ordinary income for corporations. And it uses Section 1245 and Section 1250 principles. That's all I'm going to say about that. You can look into that in further detail. I'm not going to go further, because it only applies to corporations. It's a special rule where you have 1245, 1250 depreciation, and it's subject to ordinary income. Another reason why I don't go too much into that is because, as you know, for corporate tax, corporations, C corporations, right? Everything, there's different characters, right? There's ordinary, capital gain, long-term, short-term, all that stuff. 1231, it still has all those different characterization elements. However, everything is still subject to the same tax rate. It's all subject to the same tax rate. So, yes, it affects the character, which is important for limitations and whatnot, but ultimately, it's still subject to 21% tax rate, okay? The third thing about Section 1250 is, and this is what actually we're going to talk about, this is the third item we're talking about here because it is very important, is what's called unrecaptured Section 1250. So, in Section 1H, we find the rules for characterizing capital gains and specifically for long-term capital gains and the specific rates. So there's the normal long-term capital gains rates, and this may change in the future, but the highest normal long-term capital gains rate, because remember, long-term capital gains get the preferential treatment. Short-term capital gains are taxed at ordinary income rates. So we're talking about long-term capital gains. There's basically different categories of tax. The normal, the highest, is 20%. Then we have different other rates. The next one, and going in order, is unrecaptured Section 1250, I'm going to explain that to you in a moment. That's what this topic is. This is subject to a 25% tax rate. It's not subject to a 20% tax rate. It's subject to a 25% tax rate. All right? The last, and there's some other categories, collectibles and Section 1202 stock. Collectibles in Section 1202 stock, they are subject to a 28% tax rate. 28%. Okay? Let me erase these to make it clearer so you can see. 25% and 28%. All right, so we got 20%, the normal long-term capital gains rate, the highest rate. Then unrecaptured Section 1250 is 25%, and then collectibles in Section 1202 are subject to 28%. And there might be other things, but these are the main categories. Okay, so what is unrecaptured Section 1250? Well, Under Capture Section 1250, what it does is it takes Section 1250, what we just talked about. So the same principles, right? It's real property, subject to depreciation. And again, it applies to gains, specifically capital gains, or I should say it applies to capital gains or Section 1231, but with Section 1231, it ultimately has to be a net gain. Because remember, with Section 1231, it results in a net gain. If it results in a net gain, I mean it results in a long-term capital gain. So we're talking about long-term capital gains and Section 1231 if it's a net gain. If it's a net gain. If it's a net loss, right, everything's ordinary, so that's different. And what it does is it recaptures the amount if we applied the rules of Section 1245 to the 1250 property. So I'm talking about this lesser of rule. This lesser of rule we talked about earlier, apply that. After we apply Section 1250, the regular ordinary income recapture. And what it does is, again, this does not do ordinary income. It just makes it, rather than a 20% rate, it makes it a 25% rate. So it taxes it at a different rate, a 5% difference. Okay? So again, for example, let's assume that we acquire property after 1986. Okay? After 1986. And it's a building. And we purchase a building. Actually, don't worry about the amount we purchased for. We're going to depreciate the building. Let's say we depreciate it $70,000. Let's say we buy the building a long time ago and we sell it, and we have a realized and recognized gain. Let's say of $100,000. Okay? And let's say that this property is Section 1231, long-term capital gain, whatever you want, or investment, 1231, whatever you want, business building, whatever it is. So we're going to take the $100,000 gain, we're going to apply the lesser of rule. The lesser of the realized gain or the amount of depreciation. Well, of course, the lesser is going to be the $70,000 depreciation. So the first $70,000 is subject to 25% rate rather than 20%, and then the other portion, again, assuming this is only 1231 transaction, so it results in a net gain, is going to be, so the remaining $30,000 is subject to a 20% rate. To a 20% rate. Okay? So this really explains what all these different depreciation recapture items are. So we have Section 1245 depreciation recapture, we have Section 1250 depreciation recapture, and then we have undercaptured Section 1250, which also deals with depreciation. So these are the three main depreciation recapture rules. The last thing I want to talk about is how Section 1231 fits into place, because students always get confused. I have some problems that incorporate Section 1231, Section 1240, and Section 1250, or undercapture Section 1250, I should say. I recommend going through those and see this, but the idea is that Section 1250, you have to consider Section 1250 before, because Section 1231 before you consider 1245 and 1250, but then the ultimate outcome is after. So it's kind of like in the middle of doing Section 1231, because the idea is, look, Section 1245 depreciation recapture as well as undercapture Section 1250, they apply to capital gain or Section 1231 as well as Section 1250 depreciation recapture for property acquired before 1987. You have to determine if it's capital gain or Section 1231. Well, the idea there is, okay, to do that, you got to go through the steps of capital gain, right? Capital asset, sale or exchange, or 1231 steps before you can even do this. Then you go back to 1245, take out that portion like we did here in this example, right? The $15,000 gain. We had to break that out, because if we do the netting after, that's going to affect how the things in Section 1231 hodgepodge work out and what the treatment's going to be. All right, so that really explains. If you need more information, I have videos specifically on 1245, 1250, undercapture Section 1250, as well as Section 1231, but I want to put all of them together just to help you even further.